when we look across the credit space here, whether it is Evergrande or Huarong or Suning, it's pretty concerning, it seems, though markets broadly kind of been brushing this off. Are credit spreads properly compensating investors for the risk of default here?
Good morning. Thank you for having me. I think the key message here for this year is that credit market is diverging. So we are seeing that higher quality credits have been stable, and the higher yield credits have been witnessing a lot more volatility. And that's exacerbated by this weakening technical support from investors' willingness to buy on dip. And we have seen this in both investment grade credits like Huarong, as well as high yield credits like Evergrande. So I think this year there has been a strong demand for safety, both from a duration management perspective as well as a default managed perspective. And we're actually overlooking, at least in the China high yield market, a lot of the fundamental developments, which has been stable to even improving, I would say, for the first half of the year. Take Chinese high yield property sector as an example. We have seen the strong willingness and also meaningful progress in their earnings in order to comply with the new tighter policies in terms of three red lines, as well as new policies regarding to concentrated land sales. So basically, fundamentals are taking a backseat right now, and valuation might be staying more or less attractive for extended period of time. So we do think that it is more prudent to do risk management in the sense of diversifying our risk exposure, as well as prudent credit analysis. And fundamentals are not changing. It's just that we are being compensated more properly for the potential volatility in mark-to-market.
Okay, Anne, so I guess your main points there, don't be distracted by the headlines. The fundamentals are still supportive. You have this divergence. When it comes to high yield and investment grade within the Chinese market, what is your preference? You mentioned property and real estate there. What else are you looking at?
So we definitely have a strong preference for quality in this time of diverging performance. However, I think especially for private bank clients or a lot of Asia clients, I think the absolute headline yield is still going to be a very central thesis in their investment. So I think we're focusing on the safer part of the high yield for absolute return or total return experience, as well as corporate hybrids from higher quality companies, where we can take some slight subordination risk in compensation for a good, stable return.
And you mentioned about just Huarong, Evergrande, you have China Fortune Land you can throw into the mix as well. Some saying, look, 2021 could be a potential tipping point for China's credit markets. At what point does this move from just an idiosyncratic story to something that's more systemic? What do you look for that kind of switch?
So I think in terms of systematic approach, Asia is part of emerging market. And that is going to be prone to this fund flows from global investors, even though we used to say that Asia credit market has this unique local investor base in terms of resiliency. However, this year, since we know that the local investors are hesitant to buy on dip, then that is reflected in the lack of technical support and prolonged volatility or cheaper valuation. So I think in terms of the things I'm watching, definitely the local investors' willingness to go back. I think that depends on the level of absolute yield, as well as the successful or some meaningful progress in some of the headline names. For example, the default cases we mentioned since the earlier this year.
And with the Fed surprise, how do you see yield curves in Asia looking here? Are we going to see more flattening? Is there more to reprice?
I think in terms of Fed's surprise, we were definitely thinking that the market is jumping ahead of tapering directly into hiking. Typically, we talk about tapering first, and then maybe a year later or 18 months later, we're going to start hiking. And now it seems that even though the market has reversed a lot of that move last Thursday, still market is pricing in a lot more rate hikes to begin earlier. And we hold a contrarian view. We think that the Fed is staying its course, hiking no earlier than second half of 2023. And our interest rate outlook is still going to be approaching 2.25% by this time next year. So in terms of Asia credits, as I mentioned, it's part of emerging market. It's going to suffer from higher rates just from a duration perspective and emerging market fund flow perspective. But we think that Asia credits will be more resilient because they have shorter duration, valuation is more attractive, as well as I think in terms of emerging market flows, we're also seeing outflows from emerging market equities into emerging market bonds for that additional level of support.